Is there fallout from the presidential debate? There's a dilemma for bond investors today, and is big tech sucking up all of our energy resources? These topics and the implications of cheap toilet paper on this episode of Investment Insights from Opal. Thanks for tuning in to this episode of Investment Insights from Opal Capital. My name is Jake Coulter. Joining me as always, Austin Graff and Adam Mueller. If you would like to ask the team a question, please shoot us an email, podcast@opalinvest.com, or simply scan the QR code on this screen if you're watching the video. Our first topic for this week. We've reached the midpoint of the year. The S&P 500 is up 15%. NVIDIA is up 150%. A lot has happened in the first half. What are your thoughts and implications going forward? Austin, let's start with you.
I think it's obviously been a much better year so far than most economists predicted before the year began. Currently, the S&P is at a level that wasn't expected for the entire year. With that in mind, or when the year started, economists hadn't expected this level for the entire year. But with that in mind, I think investors should be cautious about exiting the market at this point, mainly because these years tend to end up being far better than most expected. While a lot of people dwell on the historic return of 8 to 10%, in reality, returns tend not to be in that range. They tend to be either much greater or much lower. And where we are right now would indicate we could have a better than 8 to 10% return for the entire year.
Adam, what are your thoughts?
Yeah, it's interesting, Jay, because it's obviously no accident that you mentioned NVIDIA and the S&P in the same breath, right? Because the question heading into this year was, can this small cohort of 7 stocks, the Magnificent Seven, continue to drive the market, or will we see some sort of rotation or change? And the answer is, so far, 6 months into the year, they have. They've continued to drive the market. We've continued to have a market that has been led by a very small number of stocks, and if you don't own those stocks, you don't have that gain. And so now we face the same question for the second half of the year. Can they continue to drive the market forward, or will we see something change or crack?
Next topic. Last week, we had our first presidential debate. It appears to have scrambled Democratic operatives into a state of panic given President Biden's performance. Team, how could this impact the markets going forward? Adam, let's start with you.
Yeah, I love that you used the word scrambled because it made me think of what was going on inside Biden's head during that debate. I mean, look, the real winner of the debate was dementia research. What was that? That was a very sad debate to watch. It was hard to watch. I think a lot of people I know turned it off and then just read about it the next day because it was so difficult. But the reality is that markets hate uncertainty. And what the debate did was shift a little bit more certainty in the sense that the probability of a Trump win goes up, but created a whole host of other uncertainty with calls for Biden to step down. And if he does, who would the nominee be? And it feels like for the next little while, until that uncertainty rectifies itself, there could be additional volatility in the markets, simply because the debate performance was not just bad, but bad for a very specific reason, which makes the American voting public very uncomfortable.
Austin, how should investors look at last week's presidential debate?
Yeah, I think you look at the market reaction following the debate, and it was kind of ho-hum. In reality, elections don't tend to really drive broader market indices much, regardless of what the talking heads say on TV. Where most of the action happens is underneath the surface. So as we saw on Friday following the debate, we saw a number of the green energy plays suffer because the expectation is they're not going to get the same amount of subsidies going forward as they've gotten in the past. And some, I would say, beneficiaries of a Republican administration, like private prisons, did extremely well. And we saw this kind of give and take within the market, but the market was relatively flat. So I think that investors should think about that from a broader perspective as we go through the remainder of the year, and consider the fact that the election's likely not to impact the broad market much, but it might impact what's going on underneath the surface.
Yeah, I don't know that there's a publicly traded company that makes panic rooms, but that would have been a stock to own.
Next topic. The largest tech companies are reportedly looking to buy nuclear power directly from plants, which could sap some critical resources from the grid. What does this mean for the energy markets going forward? Austin, we'll start with you.
I think it's a really interesting dynamic, not only for the energy markets, but also for AI, because to this point, most people haven't seen any negative externalities from AI other than their portfolios aren't going up as much as NVIDIA. But as we go forward, the demand for electricity is going to go from a GDP-like grower to GDP minus grower to a GDP or 2 times GDP grower, which is going to impact individuals' electricity bills as the country is not developing electricity capacity as quickly as they need to absorb this demand. And so I think as consumer electric bills go up, you're going to see more outrage over how much electricity is being consumed by these large data centers. And it will be interesting to see how that plays out in the square of public opinion.
Adam, what are your thoughts?
Yeah, it's interesting, right? Because until recently, I think people sort of thought the gating item on AI and what it was computing power, and what separates us, from Skynet from Terminator is simply faster chips. But in reality, there's another huge gating item, which is the power to run everything. And as Austin mentioned, it's a supply-demand dynamic that can lead to higher pricing in what's a very regulated industry. You can't just plop down a nuclear plant anywhere and turn it on. Those take a lot of planning, a lot of regulation has to go your way, and it takes a long time. So when there's a mismatch of supply, when supply doesn't meet demand in the energy market, it's not a quick fix. And in an era where you don't want to burn more coal or and people are very sensitive around environmental issues. There's a real needle that has to get thread here to make sure that the data centers and the AI have the energy they need, while not just screwing over consumers that just want to turn their reading lamp on at night.
Yeah, I think that one of the things that's kind of lost in the market is it's extremely hard to actually store electricity in bulk. And so as you have data centers that need a steady stream of electricity, and the key source of power to date has been renewable energy. So whether that be wind or solar, wind and solar are historically very unreliable in how they deliver power. And so we need something to fill in the gap. I think the solution here has been nuclear, but keep in mind, it took over a decade to develop the last nuclear reactor in the US, and it was tens of billions of dollars over budget. And so as we kind of try to solve this equation, it's likely going to mean we're using more brown energy, or customers are paying significantly more for what they view as kind of a basic necessity of life, which is the ability to turn on their reading light or have their AC running all night.
Our next topic centers on fixed income investing, and frankly, fixed income investing has become very difficult. On a risk-adjusted basis, it appears there's little reason to own investment-grade credit today. What areas of the fixed income market have a risk-reward profile that even make it worth investing in today? Austin, let's start with you.
Yeah, I think it's interesting, Jay, that you say today there's very little reason to own investment-grade credit. And I would say if you look historically over the last 100 plus years, historically, there's been very little reason to own investment grade credit. And that being said, most advisors will put their clients in a 60-40 portfolio that has a decent chunk of that 40% in investment grade credit. In reality, what they're looking for from that 40% is dry powder when equity markets go down, so that they can dollar cost average into the market. Now, if that's your goal with that money, you should just put it into treasuries. The issue with investment grade credit is when the market goes haywire, yields tend to gap out, causing prices to go down on investment grade credit. So why would you actually own it? If you look at the historical returns for the real returns for bonds in the US, you're looking at something like 1 to 3% returns. If you look at the historical real returns for equities in the US, you're looking at something in terms of 8 to 9% returns. So why would you sit here and have money invested for the long term in investment grade credit when you could put it in equities and get almost 3 times the expected return over a longer duration?
Adam, any thoughts around the fixed income marketplace today?
Yeah, no, I mean, I agree with Austin. And in a world where if your fixed income portfolio is essentially either your savings account or your piggy bank, and you want to be able to access it without having to lock in losses due to market volatility, in a world where you can still buy short dated, U.S. debt at close close or above 5%, why would you buy anything else? And you can buy 3-month US T-bills and just let them ladder them up, let them expire, and you never have any risk of having to sell prematurely.
I think the actual investment grade market says a lot about what's going on in the underlying economy, because essentially the Fed gave so much of they gave so much of an indication that they were going to raise rates 2 years ago, that anyone that had the capacity to issue bonds outside of the federal government issued bonds, and they fixed out or termed out their financing. So now their cost of debt is actually below what a lot of governments, or even the US government, is paying for, treasuries. And that speaks to two things. One, it speaks to the intelligence of CFOs at investment grade companies in the US. It also speaks to the stupidity of the US Treasury, because they didn't lock in their interest rate when they knew interest rates were at all-time lows. And now they and the US citizens are paying the price.
Yeah, the only caveat, I suppose, is if you are running a very large pension plan, where your intent is to buy bonds and hold them through expiration, maybe there are certain corporate issuances that make some sense. But if as rates change, you could still get stuck, wishing that you had access, wishing that you hadn't done that.
Yeah, and that exact dynamic is what's driving the option adjusted spread to such low levels, right? We're down to like 50 basis points as the premium on a AA versus the comparable US Treasury. And that's historically low level. And the reason is because you have these pensions that are required to invest in the asset class due to their investment policy statement, but there's no supply. So there's a ton of demand, no supply, which is driving up prices, driving down yields, and providing very little reason for anyone that isn't required to invest in the asset class to allocate any money there.
All right. When I was a young man, a kid, I loved playing with Lincoln Logs. When my son was a kid, he loved playing with Lincoln Logs. Their parent company, Basic Fun, recently went bankrupt. They're also the owners of the Care Bear franchise that my sisters played with when they were younger. Redbox filed a recent bankruptcy. Guys, these bankruptcies are starting to pile up. Adam, what's your take? What do investors need to be thinking about?
It was interesting to see the news that Redbox had gone, the company that owned Redbox had gone bankrupt. Because I was surprised, not that they'd gone bankrupt, that they even still existed. And it was a bit of a reminder that these old technologies can have these long tails sometimes. Like, there are probably still millions of people in America paying $20 a month for their AOL dial-up internet. Many of whom don't use it and probably just forgot that they have the subscription. But look, I think that small businesses are a huge part of the U.S. economy, but they're very difficult to run. Most of them don't survive. It's technology changes. No one's using. I can't remember. I don't even have a DVD player, let alone. I can't remember the last time I've seen a Redbox. So it was really interesting to me that it lasted this long. But it also speaks to the difficulty, particularly in the current environment. If you're a small business and your debt has come due and you need to refinance, you might be done, as given where rates have gone over the last 5 years.
I think that there's a lot going on underneath the surface, and it's not necessarily hitting the headlines for major news outlets. But we're seeing, as Jay referenced, a number of these small bankruptcies start to pile up, and a lot of it has to do with higher interest rates and many of the companies not being able to sustain their business at higher interest levels. Maybe they levered up with lower rates or various different issues. And I think as we proceed along in the economy with rates being higher than many people expected, barring a significant decrease in interest rates, this says a lot for small cap stocks. Small cap stocks tend to rely much more heavily on financing than the large and mega cap stocks, mainly because they don't have the same access to capital markets, and also because, given their size, they're considered a bit more risky. And if many of these small caps come up to maturity walls and can't refinance, they're going to end up in the same place as both companies, whether it be Redbox or the Lincoln Logs and Care Bear franchises. I think from a broader perspective, investors should be really cautious on owning small caps at this point, mainly because those interest rates are creating a pretty significant headwind for them, even if there is an underlying relatively strong economy for them to participate in. So beware that small companies, while they tend to do well in economic upcycles, might not do as well in an upcycle that involves higher interest rates because of that refinancing risk.
Let's go a little bit deeper on that because, as you mentioned, Austin, there's some risk in small cap companies today. In fact, small caps today trade at the lowest they ever have relative to large caps in their history. Adam, what do you think the portfolio implications should be for people who are long-term investors?
Look, I think small caps. I think they're going to be more volatile. It's interesting. The valuation disparity is interesting. I do wonder, and I haven't done this analysis, but how much of it is because of the sort of Magnificent Seven effect, where you've just had some of the large cap companies, become multi-trillion-dollar companies. But look, if you can find a basket of small caps that have strong balance sheets and that will be able to refinance any debt they have, or that don't have debt on their balance sheet, but that will be around in 5 to 10 years with low valuations, that could be an interesting way to diversify a portfolio. But anyone if the balance sheet isn't, strong, I'd be very careful.
Yeah, the Russell 2000 is actually down 2% year to date or through the first half of the year compared to the 15% up in the S&P 500, which is a historical dispergence. A lot of it has to do because of this refinancing risk. The market is much smarter than any of us, and it's been sniffing this out for some time. Now, if you do need to have small cap exposure, we wouldn't suggest kind of the peanut butter spreading approach where you just own a little bit of everything, because you will own a lot of these value traps. I'd rather focus on the small cap growth indices, because they're going to tend to have more top line growth and less financial leverage on the balance sheet, which will help them get through any hiccups that could likely come. Now, if you do see the Fed start to aggressively reduce rates, which could happen for any number of reasons, then it's time to be owning small cap value, because you're going to see a lot of these companies that are currently being left for dead get their refinancing done and then all of a sudden return to profitability. And, they'll buy another 5 to 7 years of life. But that's a big if in this environment, as we've seen the economy's not slowing as quickly as the Fed's expected. And so it's obviously having a pretty significant impact on small companies.
All right, team, our final topic. Let's center this around an article from the Wall Street Journal today, where they reported that companies selling everyday goods say lower income consumers are struggling, but better off households are spending freely. Adam, we talked about this on our last podcast. What does this mean for investors?
Look, I think it's another interesting data point where the rich are fine and the lower and lower middle class are starting to struggle. And as that dynamic continues to evolve and to grow, that's something that could sort of pull the economy apart. And with the article talking about people having to trade down, it cites toilet paper, and man, I feel for you if you got to go down to single ply.
Austin, what are your thoughts?
I think that there's obviously the article that Adam's referencing talking about how the lower end brands, whether that be toilet paper or razors, are benefiting from trade downs. But we're also seeing many of the, let's say, lower tier restaurant operators coming out with value meals. So you're talking about the $5 meals with McDonald's and Burger King. And I think it says more about the price increases that a lot of these companies forced through 2 or 3 years ago when inflation was high than it says about where we are today. And there's likely a price adjustment that needs to be made. They're going the shortcut and using, deals and coupons to try to reduce average pricing. But consumers are a little upset. Like they don't like paying, $10 for a Happy Meal at McDonald's, or paying, a significant amount of whatever their take home pay is to buy basic goods, whether that be cereal or toilet paper. And so I think as we look out from a impact on equities and markets, these companies that were historically more predictable in down markets are actually struggling right now because they pushed through so much pricing 2 years ago. If you looked at top line growth, most of it was, they'd be up 5 to 7% on pricing. Volumes would be down 3 to 4%. And then they'd see a nice low to mid single digit revenue growth number, and they'd see margin expansion, and investors were really happy and they paid premiums for that. Well, going forward, as the pricing comes back down, if they can't get volumes to support that, they're going to see volume declines for the first time in a very long time. And we're not going to be able to support the valuations we're seeing in some of these more stable companies. So I think investors need to be cautious on how they think about protection in a down market. And it might not be the historical buy consumer staples or buy fast food restaurants when times are tough, because everyone's going to be trading down. It does seem that the people who are at the lower end of the economy are trading away and not trading down. And the people at the higher end of the economy are not trading down because they don't need to. So it's leaving a gap in many of these more value-oriented spaces.
Yeah, like if you go back sort of 4 years and you think, we had sort of a generational high government stimulus due to the pandemic, followed by generationally high inflation, followed by generationally high price increases to counter the inflation. And where are we now? All that's happened, and where do we sit now? And an interesting chart in that article talks about adults who could cover a $400 emergency cost in cash. And you go back to from 2013 to 2021, that went up from 50% of adults to almost 2/3 of adults, or over 2/3 of adults. And in the last year or so, it's started to come back down. And that sort of, it doesn't suggest we're at a crisis level yet. But if this trend continues, at some point, the economy will crack.
It's a sign that the government stimulus and the yellow profits have actually finally started to fade away.
Right.
And so we're seeing a more normalized economy, which is going to provide some unique outcomes from a corporate earnings perspective. And it'll be really interesting to see how that kind of plays out going forward. And, tying something that we talked about earlier, what happens if your electricity bill is up 50%? And, you're not able to buy as many, Lucky Charms at the grocery store because prices are also up 20 or 30%. So it could create a unique dynamic. And heading into a presidential election, who knows how that's going to play out.
Yeah, and these consumer staples companies that went from several years of price increases some of them are now back to pre-COVID couponing and discounting. So we've come full circle. And at some point, this will impact sort of aggregate growth, GDP.
Let's wrap with that. A programming note, our next recording will be done live from Austin, Texas in 2 weeks at the home of 49 Financial. If you'd like to ask us a question for any of our shows, please email podcast@opalinvest.com. Thanks for watching.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.